Okay, so this is like I don't know if there's a homework question on it. It's quite like a minor point, but it's in the chapter, so might as well talk about it. Um, if there's a mistake in your count of inventory, okay, um, that's going to affect your cost of goods sold, which is going to affect your profit, which is the same as net income, okay, or gross profit, which is going to affect your net income. So, uh, if the mistake is not systemic, meaning it was like a one-time mistake, you went in and counted wrong, it will actually fix itself over a number of periods. Okay, so let's just follow this example and see. Okay, so in this first period, what it's saying is that you basically overstated your inventory by $5,000. So this $15,000, you went in and counted your inventory. It should have been 10,000, but you said it's 15,000. Okay, it's just overstated by 5,000. So that resulted in um, basically a cost of goods sold that was, again, if inventory is too high, cost of goods sold is going to be too low. Okay, so that means if your cost of goods sold is too low, you're going to show extra profit. Okay, so this should have been actually 50K, right? So you're overstating it. But let's say uh, in the next period you don't make the same mistake, but this mistake from the last period is going to carry over. It's going to be your starting balance. If everything else goes the same and you kind of count the inventory correctly at the end of the next period, you're going to kind of understate this balance because you're basically going to have started the period with inflated inventory to begin with, and so when you calculate cost of goods sold, it's going to be too high. Okay, because this is too high. Um, this is correct. If you just look at the math, it kind of self-corrects. So the extra cost of goods sold that is added here, between these two, it kind of balances out. Okay, and why this is the case, it really has to do with the details of this math, where you take your your beginning balance plus additions minus the ending balance gives you the cost of goods sold. Because this mistake is carried forward, the math works out such that between these two, it kind of averages to the correct amount. Okay. Now, I guess knowing this is somewhat important. Just the math is kind of interesting, but like I don't know a realistic scenario where this would happen. This is just kind of a contrived thing in the book. So yeah, I don't know. It's just a kind of cool math to see that it works out like that. Um, but really, if you had done the counts correctly, this would have been 50. This would have been 50. This would have been 50. Okay. So the fact that you're overstating this and understating this, it still averages out to 50,000 over the 2 years. So yeah, I don't think this is super important to know, but I think it is semi kind of cool that it corrects itself. What we can take away is this framework that we have here, where we have beginning balance plus additions minus your cost of goods sold equals ending. And what we're doing is solving for cost of goods sold. So it's beginning balance plus your additions minus your ending balance equals cost of goods sold. So again, we've seen this framework, and so it's just being applied in a different context with inventory this time.